So the first thing we talked about when we started the class was that the number one strategy to making money in forex trading is market structure. Market structure is the fundamental aspect of trading. Every other strategy, be it the BTMM strategy, the ICT method, the moving average crosses, and every other strategy you can think of, all borrow the lead from market structure. So when you as a trader are studying the market, you're studying based off technical analysis so that you can now use all of the things that price is doing, which we also call price action, to decide whether you should take a buy or a sell. Because as the market moves, once the market opens, the only thing it does is to buy or to sell. So the market cannot do any other thing but buy or sell, because when we say forex trading, we mean we're exchanging one currency for the other. So as we're doing that, we are, trading. Like with everything else that has to do with trading, you buy and you sell, or you exchange one thing for the other. So for you to decide whether or not a particular instrument is a buy opportunity or is a sell opportunity, you need to be able to understand market structure enough to combine technical analysis with price action. At the end of this revision, we're going to talk about fundamental analysis and how you can bring both of them together. So here you are understanding how to interpret the chart. And then fundamental analysis just pretty well tells you what the news is saying, what's on the news, what are they saying, and all of that. Although as a trader, you cannot base your 100% on fundamental analysis. That's the reason why a professional trader will always combine both. So you're combining market structure, which you can also refer to as technical analysis. You're combining it with fundamental analysis. So technical analysis and fundamental analysis combined together will help you get a better reading or help you understand price better. So during the course of this class, we've studied the basics, the intermediate and the advanced level of market structure, which started with understanding that the market will move in either of three directions. It will move either in the upward direction, which we call the uptrend or the bullish trend, or it will move in the downward direction, which we call the downtrend or the bearish trend, or it will move sideways, which we call a consolidation. So when the market is moving sideways, we don't often take trades like that, because a sideways market is a trap market. So what we try to do when we see a market consolidating is to wait for it to break out. And most of the time, when the market is moving sideways, it tends to break out in a tricky direction. So say the market is moving sideways this way, and it breaks to the downside. More often than not, it intends to go up. So some traders will say because it has broken down, it means it wants to sell. That's not always the case, because as far as consolidation goes, I've come to see consolidation as a market indicator. What is it indicating? It is indicating exhaustion in price. So when the market has been moving towards a particular trend and it has approached a particular level, it tends to become exhausted and begins to move sideways. So as it's moving sideways, some people are entering buy, some people are entering sell. It traps them, they're all in here, and it keeps taking them for a jolly ride. And then sometimes it breaks out of the consolidation, and some traders believe that's the direction it wants to go, but that's not often the case, because sometimes it could break downwards, and then before you know, it starts trending upwards. So when you see a consolidating market, you don't try to trade it. If you enter a consolidating market, for example, you want to find a way to exit, because staying in a consolidating market will not yield you profit. The market will just be taking you into profit and loss, and you'll be wasting money paying swap, paying commission. So a consolidating market is a market you want to stay in. So if you notice that you've been in a trade for one whole day and the market hasn't made any major move, it's best to exit the trade and wait for another opportunity to take the trade. So like I said, consolidation is one way to note price action. So say you're studying the market and you've seen that the market has moved considerably, and then before you know, it begins to consolidate. When you see stuff like that, expect the market to move in the trick direction. So say it breaks towards the downside, it wants to continue upward. Where are the places you could find consolidation? You can find consolidation at the beginning of a new trend, say at the key level, say key level buy zone or key level sell zone, because that market has been moving. So this one has been moving from here, and then it got here and starts consolidating. Then you see the market breakdown, give you a W and start trending up. This is